Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit homegain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to homegain.com. Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate 360 is designed to build the Washington, D.C. Metro's housing and credit markets one house at a time. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. I want to dive back into Bernanke's comments at the Fed meeting last week. One of the other things, he actually, on Bernanke, on the meaning of exceptionally low rates, he was quoted as saying, one of the reasons that the language in the statement is sometimes a little vaguer than you would like is because we're trying to get a consensus among 17 or at least 10 people, and different members or participants in the FOMC might have somewhat different views on what exceptionally low means. Personally, I think it means something close to where we are now. Well, it's kind of hard to go much lower than 0%. Wouldn't you agree, Louis?
That is exceptionally low by any definition.
Yeah. So I guess it's just more of, I think the markets are looking for him to give a definitive date for, hey, when are we going to start raising these up? And what he's telling me, at least, is that he has no intentions of raising rates until 2014, which I might just go ahead and extend that to 15 or 16 at this point. Because
he's already extended it.
Yeah, and it's just, he keeps pushing back the term, and it's not, I think before it was like 2012, then it was 2013.
It was after the election in 2013.
Right. So there, and after this year's election, it's probably going to end up being 2015. So
the real question, Ryan, is when are they going to do another round of quantitative easing? You know they're going to do that.
Right, because all of the data is suggesting that employment's not getting better. He even made reference in his comments at the Fed meeting that it doesn't look as strong as it's supposed to be, and that a lot of the employment numbers that came out hotter than expected in March and February were due to seasonal having better, obviously better overall temperatures, very mild winter, that people were hiring on more people, so he's not expecting the 250,000 a month that they were seeing in those months. So, I don't really see this employment situation getting much better. As a matter of fact, there was another article that came out in CNN Money today that a lot of analysts are actually projecting a huge layoff on Wall Street. They are actually predicting that the cuts could eliminate 21,000 jobs, rivaling that of the amount of jobs that were cut during the financial crisis. So, I mean, all signs are pointing to where everything is getting worse, not better.
The economy needs to rebuild, and it's not going to rebuild by layering more debt on top of it.
No, and it's just going to make it harder and harder for us to get out ultimately, if we're able to.
And it's going to make the dollar more and more devalued.
And that is why, we have always been big advocates of saying that, silver and gold is such a strong play right now, because ultimately by devaluing the dollar and the currency that we have, I mean, down the road, the paper's not going to be worth anything. When you're paying, $30 to buy a gallon of milk, everybody's going to be saying, well, what happened? What went wrong? What went wrong?
The central bank's response to that, and you saw it in Zimbabwe, you just print more notes and you start adding zeros to the end of the notes.
Yep.
That doesn't fix anything.
Not at all. Not at all.
If you look at right now, home ownership, I just saw an article today, is down to a 15-year low. And the Case-Shiller reports that home prices are now at pre-bubble pricing. So all the government intervention, the Fed's policies that were designed to help to get people into homes have actually now backfired. They got them into homes temporarily. They created a housing bubble. And now they're all out of the homes because of the high foreclosure rates. And then, unfortunately, you're seeing foreigners buy those homes now. So as a direct result of all those policies, although Bernanke says that the low interest rates of himself and his predecessor Greenspan did not contribute to the housing bubble, it did.
Yeah.
It's not even disputable, and for him to go around the college campuses and say that his policies really were not a result of the housing bubble is ludicrous. It's as ludicrous as a statement that if inflation starts to heat up, that he can stop it. He said that on 60 Minutes a year and a half ago.
Yeah, well, it's interesting, Louis, because I look at things like this. Okay, if the lending standards weren't so tight right now, if it wasn't, darn near impossible to get a loan right now, and we had this low interest rate policy for an extended period of time, we would have the same boom and bust in the real estate market as we had 4 or 5 years ago.
That's right.
Because, when the money's that cheap, everybody wants to go out and buy a house. But now it's just not as easy. There's people.
Which should tell you that the low interest rates are not really helping the economy at all.
No, the only people it's helping is the banks.
Right, and the U.S. government default.
Yes. Yeah.
The U.S. government default.
While the general, the general consumer, the average Joe out there is still struggling, still, trying to save money.
More.
Right.
And paying more in inflation.
Yeah. And they're, being able to try to save money. I mean, a lot of the savings accounts, the most they're willing to pay is, 1% these days?
Well, you can save money. We mentioned this earlier. You end up having to invest in stocks, and you may not be prepared to do that. Or worse, you throw it into a mutual fund, and one of the big banks gets the management fee, and you don't really do much better than the general market in the mutual fund.
Yeah, well, Ron Paul was also in that interview stating that, a lot of what's created with this low interest rate policy is malinvestment.
And Ron Paul talks about that all the time, the malinvestment, and about debt having to be liquidated when bad investments are made. They need to be liquidated.
Yeah,
so that you have creative destruction, and then the money goes back into the system the way, in a smart way, through proper investment, not through government intervention in buying shares in Cylinder or whatever they did, funding. Government doesn't know where to allocate money. The market knows. And no one knows. No one is smart enough to know how to manage all the money in an economy and where to spend it. And even if you did, it's still unjust because you're favoring one party over another. You're taking money or printing money, which basically is a tax on people who hold money, and you're allocating it somewhere. And unfortunately, they end up allocating it in the wrong places anyway. Not that they should even be involved in that, but the decisions that they make on where to allocate it generally don't work out.
Yeah, this economy has always been founded on the principle of people having credit extended to them, whether it's in the form of a credit card, a mortgage, whatever it may be. Now, we don't have that same access to these loans, and people don't have the ability to take out that amount of credit. I mean, it's pretty telling. The chart from Zero Hedge that shows, without much commentary is needed, the only ratio that matters for the U.S. economy, the change in U.S. public debt, and this is the first quarter, was $359.1 billion, and the U.S. GDP was $142.4 in the first quarter. So basically, it takes $2.52 in new debt to buy $1 of economic growth. That's pretty telling. It would be better if it was $1 of new debt to create $2.52.
Well, actually, debt shouldn't really be creating wealth. Debt is what they're doing now to keep the economy up by spending, because 70% of the U.S. economy is just domestic spending.
Sure. Well, there's a time and a place for debt, for loans to be made, but it shouldn't be the foundation of any business either.
But not for speculation. You got to remember the housing bubble was called by borrowing for speculation, not borrowing just so you can own an asset.
True enough. I mean, and that's more or less, and that's why I'm saying that, if there's no doc and stated loans were still around today, that we would have a mess, an absolute mess going on all over again. There's an article in the Wall Street Journal where it's saying stunned home buyers find the bidding wars are back. And it was saying that, it's not necessarily that the competitive bidding was producing huge price increases or huge profits for these people, but it was that, people are just in multiple contract situations on all these homes. And what I really think it is it's a supply and demand thing. There's just not near as many homes out there available for the amount of people that are looking to buy at this point, and especially homes that are in great move-in condition. So those are the homes that you can move into, and you just throw your furniture down and you're ready to go. Those houses are at very high demand right now.
And those houses reflect not an investment opportunity, but a home shelter opportunity, meaning that people need a place to live, and it's economic for them to do so, to purchase a house. And there just aren't enough of them in the Washington, D.C. metro area.
Yeah, absolutely. In the D.C. metro area, it's relatively crazy, but I mean, I'm hearing stories day in and day out right now that people are, they're finding a house and they really love it, and they're having to bid it up $10,000 and they're still not getting it. So that is kind of scary. You're starting to see these things happen all over again. And, there are a lot of people out there trying to take advantage of the low interest rates and then just finding out that, hey, we got our loan lined up, we're ready to go, but we still can't we're getting outbid on everything that we bid on.
But Ryan, that's less frightening than a speculative bubble. What you're talking about here appears to be a market dynamic where supply is below demand.
Absolutely.
It's just a natural market imbalance, and that happens. But when you actually create extensive demand through cheap credit, then you have a problem. That's what you had in the housing bubble. It doesn't seem like here cheap credit is why the housing shortage is happening in the D.C. metro. Why there's just not enough houses to fill the demand there.
Yeah, there's
it's
not
concerning. It's not really a credit bubble.
Yeah, it's not. It is. It's just concerning.
In fact, as you mentioned that people are having difficulty getting the credit.
Yeah, absolutely. I mean, that's the biggest problem is that the majority of people are just having problem getting the credit. But it's kind of like what's happening, Louis, is that the prices are shifting up on these people to the point where they no longer would qualify for that same house because instead of $350, it's now $370, and they're looking at, okay, well, what are my options now? So do I go and rent? Am I forced into rent or am I forced into buying a smaller house? And that's more or less what they're going to have to do is just buy a smaller house. But we're up on a break. When we come back, we'll talk more about the bidding wars that are back. And also, we will be looking at the long and short-term implications of foreclosures when we come back. Stay right there.